Welcome investors, let me take you on a visual journey. Subject: dividends. Dividends represent a portion of a company's profits distributed to shareholders. These payments are a way for companies to share their success with those who have invested in them. By distributing a portion of their earnings, companies can reward shareholders for their trust and investment. This practice not only incentivizes investment, but also reflects the company's financial health and profitability. When you invest in dividend-paying stocks, you become a shareholder and are entitled to a share of these profits. This means that as a shareholder, you have a stake in the company's success. The more shares you own, the larger your portion of the profits. This can be particularly appealing for investors looking for a steady stream of income, as dividends can provide regular payouts. Dividend investing involves building a portfolio of such stocks, aiming for consistent income. By carefully selecting a mix of dividend-paying stocks, investors can create a diversified portfolio that balances risk and reward. This strategy can help mitigate the impact of market volatility, as the regular income from dividends can provide a cushion against fluctuations in stock prices. Additionally, a well-constructed dividend portfolio can offer the potential for capital appreciation over time. This income can supplement your regular earnings or even fund your retirement. For many investors, dividends are an essential part of their financial planning. They can provide a reliable source of income that can be used to cover living expenses, reinvested to grow wealth, or saved for future needs. In retirement, dividend income can be particularly valuable, as it can help maintain your standard of living without having to sell off your investments. Dividend investing is a popular strategy for both novice and seasoned investors. For beginners, it offers a relatively straightforward way to start investing, with the potential for regular income and long-term growth. Experienced investors, on the other hand, may use dividend stocks to enhance their portfolios, seeking out high-yield opportunities or companies with a history of increasing their dividends. Regardless of experience level, dividend investing can be a valuable tool for building wealth and achieving financial goals. It offers a way to participate in the growth of successful companies while receiving regular cash payments. As companies grow and become more profitable, they may increase their dividend payments, providing shareholders with a growing income stream. This can be particularly attractive in a low-interest rate environment, where traditional fixed-income investments may offer limited returns. By investing in dividend-paying stocks, you can benefit from both the company's growth and the regular income from dividends. Unlike relying solely on stock price appreciation, dividends provide tangible returns on your investment. While stock prices can be volatile and unpredictable, dividends offer a more stable and predictable source of income. This can be especially important during market downturns, when stock prices may decline, but dividend payments continue. For many investors, the tangible returns from dividends can provide peace of mind and a sense of financial security. The frequency of dividend payments varies, with some companies paying quarterly, others semi-annually, and some even monthly. This flexibility allows investors to choose stocks that align with their income needs and financial goals. For example, monthly dividend payments can provide a steady stream of income that can be used to cover regular expenses, while quarterly or semi-annual payments may be more suitable for long-term savings or reinvestment. Understanding the payment schedule of your dividend stocks is an important aspect of managing your investment portfolio. The amount you receive depends on the company's dividend policy and the number of shares you own. Companies typically set their dividend policies based on their profitability, cash flow, and long-term financial goals. Some companies may prioritize paying high dividends to attract investors, while others may reinvest more of their profits back into the business to fuel growth. As a shareholder, it's important to understand the dividend policy of the companies you invest in, as this can impact your overall returns. Additionally, the number of shares you own will directly affect the amount of dividends you receive, so building a larger position in dividend-paying stocks can increase your income over time. Understanding these fundamentals is crucial for embarking on your dividend investing journey. By grasping the basics of how dividends work, you can make informed decisions about which stocks to invest in and how to build a portfolio that meets your financial goals. This knowledge can also help you navigate the complexities of the stock market, identify high-quality dividend-paying companies, and develop a strategy that balances income and growth. Whether you're just starting out or looking to enhance your existing portfolio, A solid understanding of dividend investing can be a powerful tool for achieving financial success. Not all dividend-paying stocks are created equal. While many companies offer dividends, the quality and reliability of these dividends can vary significantly. It's crucial to be discerning when selecting stocks for your dividend portfolio to ensure you are investing in companies that will provide consistent and reliable income over the long term. When selecting stocks for your dividend portfolio, it's essential to consider several factors. These factors will help you identify companies that are not only capable of paying dividends now, but are also likely to continue doing so in the future. A thorough analysis of these factors can help you build a robust and resilient dividend portfolio. Firstly, assess the company's dividend history. Look for companies with a consistent track record of paying dividends over an extended period. A long history of dividend payments is often a good indicator of a company's commitment to returning value to shareholders. Companies with a history of increasing their dividends over time are particularly attractive, as this suggests they are confident in their future earnings potential. Secondly, evaluate the company's financial health. A strong balance sheet, consistent profitability, and manageable debt levels suggest the company can sustain its dividend payments. Look for companies with solid revenue growth, healthy profit margins, and strong cash flow. These financial metrics indicate that the company is well positioned to continue generating the profits needed to support its dividend payments. Avoid companies with erratic earnings or excessive debt, as these factors can jeopardize future dividends. Companies with volatile earnings may struggle to maintain their dividend payments during periods of financial instability. Similarly, companies with high levels of debt may be forced to cut their dividends to service their debt obligations. It's important to invest in companies with stable and predictable earnings and a manageable level of debt. Furthermore, consider the company's industry and its long-term prospects. Invest in companies operating in stable or growing industries that are less susceptible to economic downturns. Industries such as utilities, consumer staples, and healthcare are often considered more stable and less cyclical, making them attractive options for dividend investors. Additionally, consider the company's competitive position within its industry and its ability to adapt to changing market conditions. Lastly, examine the dividend payout ratio, which is the percentage of earnings paid out as dividends. A sustainable payout ratio ensures the company retains enough profits for future growth and investments. A payout ratio that is too high may indicate that the company is paying out more than it can afford, which could lead to dividend cuts in the future. Conversely, a very low payout ratio may suggest that the company has room to increase its dividend payments in the future. In addition to these primary factors, there are several other considerations that can help you identify high-quality dividend stocks. For example, consider the company's dividend yield, which is the annual dividend payment divided by the stock price. A higher yield can provide a greater income stream, but it's important to ensure that the yield is sustainable and not the result of a declining stock price. Another important consideration is the company's dividend growth rate. Companies that consistently increase their dividends over time can provide a growing income stream, which can help offset the effects of inflation. Look for companies with a history of dividend growth and a strong outlook for future earnings growth. It's also important to consider the company's payout policy and management's commitment to returning value to shareholders. Some companies have a stated policy of paying out a certain percentage of their earnings as dividends, while others may be more flexible. Understanding the company's payout policy can help you assess the likelihood of future dividend payments. Finally, consider the overall economic environment and its potential impact on the company's ability to pay dividends. Economic downturns, changes in interest rates, and other macroeconomic factors can affect a company's profitability and its ability to maintain its dividend payments. It's important to stay informed about the broader economic context and how it may impact your dividend investments. By carefully considering these factors and conducting thorough research, you can build a dividend portfolio that provides a reliable and growing income stream. Dividend investing can be a powerful strategy for generating passive income and building long-term wealth, but it requires careful analysis and a disciplined approach. With the right criteria and a focus on high-quality companies, you can achieve your dividend investing goals and enjoy the benefits of a steady income stream. Dividends can play a significant role in your overall investment strategy. They can provide a steady stream of income, which can be particularly beneficial during market downturns. When stock prices fluctuate, dividends offer a cushion and can help mitigate losses. Moreover, dividends contribute to long-term portfolio growth through compounding. By reinvesting your dividends, you purchase more shares, which generate more dividends, creating a snowball effect. This compounding effect can significantly amplify your returns over time. The proportion of dividend stocks in your portfolio should align with your financial goals, risk tolerance, and time horizon. If you're aiming for income generation, a larger allocation to dividend stocks might be suitable. Conversely, if you're primarily seeking growth, a smaller allocation might be more appropriate. Investing in dividend stocks offers a compelling combination of stability and growth potential. Dividend payments provide a consistent income stream, reducing the volatility of your portfolio, especially during market fluctuations. This stability can be particularly appealing to risk-averse investors or those nearing retirement. Furthermore, companies that consistently pay and increase their dividends tend to exhibit strong financial performance over the long term. These companies often prioritize shareholder value and demonstrate a commitment to sustainable growth. By investing in such companies, you align yourself with their success and participate in their growth trajectory. Over time, the compounding effect of reinvested dividends can significantly enhance your total returns, outpacing inflation and building substantial wealth. The stock market is replete with examples of companies that have consistently paid and increased their dividends for decades. These dividend champions have weathered economic storms, recessions, and market crashes while rewarding their shareholders with steadily growing income streams. Consider the example of Coca-Cola, a beverage giant that has paid dividends for over a century and increased them for over 60 consecutive years. Similarly, Johnson Johnson, a healthcare conglomerate, boasts an impressive track record of dividend growth, demonstrating resilience and profitability. These examples highlight the power of dividend investing and its potential to generate substantial wealth over time. By investing in such established companies with a proven track record, you can benefit from their stability, profitability, and commitment to shareholder value. While dividend investing offers numerous advantages, it is not without its challenges and potential pitfalls. Many investors are drawn to dividend-paying stocks because of the promise of regular income and the potential for long-term growth. However, it's essential to approach dividend investing with a well-informed strategy to avoid common mistakes that can undermine your investment goals. One of the most common mistakes is chasing high dividend yields without considering the underlying fundamentals of the company. A high dividend yield can be enticing, but it often comes with increased risk. It's crucial to understand why a company is offering such a high yield. Is it because the company is in financial trouble and trying to attract investors? Or is it because the stock price has dropped significantly, making the yield appear higher? Without thorough research, you might end up investing in a company that is on the brink of cutting its dividend or worse, going bankrupt. Extremely high yields can sometimes indicate financial distress and a higher risk of dividend cuts. Companies in financial trouble may offer high yields to lure investors, but this can be a red flag. When a company is struggling, it may not be able to sustain its dividend payments, leading to cuts or suspensions. This can result in a significant loss of income for investors who rely on those dividends. Therefore, it's essential to look beyond the yield and examine the company's financial health, including its earnings, cash flow, and debt levels. Another mistake is neglecting diversification. Diversification is a fundamental principle of investing that helps spread risk across different assets. In the context of dividend investing, this means not putting all your money into a few high-yielding stocks. While it might be tempting to concentrate your investments in a handful of companies that offer attractive dividends, this approach can backfire if one or more of those companies face challenges. Concentrating your portfolio in a few dividend-paying stocks exposes you to greater risk if one or more of those companies face challenges. For example, if you invest heavily in a single industry, such as energy or real estate, and that industry experiences a downturn, your entire portfolio could suffer. Diversification helps mitigate this risk by spreading your investments across different industries, sectors, and company sizes. This way, if one sector underperforms, the impact on your overall portfolio is minimized. Diversifying across industries, sectors, and company sizes can mitigate this risk. By investing in a mix of large-cap, mid-cap, and small-cap companies, as well as different sectors like technology, healthcare, and consumer goods, you can create a more balanced and resilient portfolio. This approach not only reduces risk, but also increases the potential for growth, as different sectors and companies may perform well at different times. Furthermore, it's crucial to avoid overpaying for dividend stocks. Just because a company pays dividends doesn't automatically make it a good investment. The price you pay for a stock is a critical factor in determining your overall return. Overpaying for a stock can erode your returns and increase your risk. Just because a company pays dividends doesn't automatically make it a good investment. It's essential to evaluate the company's overall financial health and growth prospects. Look at factors such as revenue growth, profit margins, and return on equity. A company with strong fundamentals is more likely to sustain and grow its dividend payments over time. Consider the company's valuation metrics, such as price-to-earnings ratio and price-to-book ratio, to ensure you're not overpaying for its dividend stream. These metrics can help you determine whether a stock is fairly valued, overvalued, or undervalued. A high price-to-earnings ratio, for example, might indicate that a stock is overpriced relative to its earnings, which could limit your potential returns. On the other hand, a low price-to-book ratio might suggest that a stock is undervalued and could offer a good buying opportunity. By carefully evaluating these metrics, you can make more informed investment decisions and avoid the pitfalls of overpaying for dividend stocks. Embarking on your dividend investing journey is easier than you might think. Start by determining your financial goals, risk tolerance, and investment timeline. These factors will guide your investment decisions and help you create a portfolio aligned with your objectives. Next, research and select dividend-paying stocks that meet your criteria. Consider using online resources, financial publications, and seeking guidance from financial advisors if needed. Remember to diversify your holdings across industries and companies to mitigate risk. Once you've chosen your stocks, open a brokerage account that allows you to buy and sell stocks. Many online brokerage platforms offer user-friendly interfaces and a wide range of investment options. Start small and gradually build your portfolio over time, reinvesting your dividends to accelerate your progress. Dividend investing offers a compelling pathway to financial freedom, providing a steady stream of income and the potential for long-term wealth creation. By understanding the fundamentals, choosing wisely, and avoiding common pitfalls, you can harness the power of dividends to achieve your financial goals. Remember to stay informed, conduct thorough research, and seek professional advice when needed. With patience, discipline, and a long-term perspective, dividend investing can pave the way to a more secure and prosperous financial future. Don't forget to subscribe to our channel for more insights and visit our website for detailed information and resources.